Liquidity ratios provide information about the firm's liquidity. So the primary concern is the firm's ability to pay its bills over the short run without any stress. As we already discussed, when we talk about short term, we mean anything less than 1 year. So the focus of liquidity ratios is on current assets and current liabilities that we already discussed in previous topics. So liquidity ratios are interesting to short-term creditors because they want to know whether you are able to pay your short-term liabilities or not. For example, as a financial manager, you may constantly work with banks and other short-term lenders, and one of the aspects, one of the things that you need to look at it to maybe report to your short-term creditors is liquidity ratios. So one of the advantages of using current assets and current liabilities is that their book values and market values are not usually much different, so we expect them to be similar. However, like any other thing near to cash, their value may change quickly. So the value of the current asset and current liability today may be totally different from a point in the future. So there are a few ratios that I want to discuss under liquidity ratios category. So this is what I have provided here is the balance sheet of the company that you are working on it, and I will use the same example. I will be using the same balance sheet, and same income statement in all examples for computing all ratios that we will discuss in this lecture. So now we are working on liquidity ratio. So we focus only on current assets, as you can see here, current assets and current liabilities. So means any asset with a life of less than 1 year, and any debt, any liability that should be paid off in less than 1 year. So liquidity ratios, for liquidity ratios, we will compute current ratios, current ratio, quick ratio, and cash ratio. So these are the three most common ratios under liquidity ratio that we want to discuss. So the question for liquidity ratios is, we use liquidity ratios to answer this question: are there enough liquid assets to pay current obligations or not? The most well-known and most commonly used current liquidity ratio is current ratio, which is computed by dividing current asset by current liability. So you remember that we had a formula to compute net working capital, which was current assets minus current liability, right? But here we want to divide current asset by current liability, so it's very similar, right? For a healthy firm, we discussed that net working capital is expected to be positive, right? Means we expect current asset should be greater than current liability. This means that this firm is able to pay its current liability, means those obligations that their life is less than their maturity is less than 1 year should be less than the current assets that we have in the company, right? So for net working capital, we already discussed that we expect a positive. You remember net working capital, current assets minus current liability. It was for previous topic. We expect a positive to be positive for healthy firms. So current ratio, which is current asset divided by current liability, we expect to be greater than 1. So for most cases, for most companies, we expect a current ratio of greater than 1. This means the company can cover its current liabilities using its current assets, right? Because current assets and liabilities are converted to cash over the following 12 months, the current ratio is a measure of short-term liquidity, right? So what's the unit analysis of current ratio? The unit of measurement is either dollars or times. So in this example, current assets, as you can see here, okay, let's use the data for 2019. So current asset has been reported here. Where is current asset? Here. Current asset, the total is $708, but all have been reported in $1,000,000, right? So this is $708 million. So 708 divided by, as you can see, divided by current liability. What is the current liability? The total value is for 2019 is $540 million. So 708 divided by 540 will give you 1.31 times or dollar. This means that the company has $1.31 in current assets for every $1 in current liabilities. Or we could say that the company has its current liabilities covered 1.31 times over. So a creditor, and more specifically a short-term creditor, such as, for example, supplier, prefers higher current ratio. They prefer companies to have higher current ratios because this means less stress for the firm to pay its suppliers, right? However, to the firm, although we say we prefer higher current ratio because this means more liquidity, but more liquidity means may show that the company is not efficient in using the cash and other short-term assets because when you have cash you can't there's no earning for keeping cash, right? So too much cash is not really good, right? It's better to use the cash, right? It's better to use the cash to make more money, right? So if you put your cash under your mattress, there is no benefit for it. This is the logic behind it. So although for companies we also prefer higher current ratios, but we need to be careful because this may mean that the company is not efficient in using cash and its short-term assets. So usually we would expect to see a current ratio of at least 1 as we discussed because we expect the company to be able to cover its current liabilities using its current assets. So the current ratio, like any other ratio, is affected by different types of transactions. Let me give you an example. For example, suppose that a firm borrows over the long term to raise money. For example, a company issues 10 years bond. It means they borrow money for 10 years, right? It's a loan, a 10-year loan, right? This means they will have cash because they borrowed 10-year loan. They got a 10-year loan they borrowed for the long term. So now they have cash, right? So what happened? So the short-term effect would be an increase in cash from issuing long-term debt. In this case, as current liability has not changed, so the current ratio may increase, right? So this is the way. So this is why I'm giving you this example. This means that you need to use other ratios as well. You need to look at other figures as well to be able to interpret, to analyze a company, right? So a company may have a higher current ratio just because they recently got a long-term bond, right? So their current liability has not changed, the current debt has not changed, but the current asset, because of the amount of cash they injected in the company, because they borrowed money for long term, may have changed. So why I use this example? Be careful. You cannot just blindly say, okay, higher current ratio, so this means it's a good company or not, right? So you need to look at other aspects as well. So the second ratio we want to discuss is quick ratio. Why do we need quick ratio? The logic behind using quick ratio is inventory is usually the least liquid current asset, right? And some of the inventory may later be damaged, spoiled, or even lost. Also, large inventories are usually a sign of short-term trouble. These may show that the firm may have overestimated sales or as a result, they may have overproduced, right? In this case, the firm may have a large portion of its liquidity in inventory, which is considered as a slow-moving current asset, right? It's the least liquid asset. So a company that because of some mismanagement, they have overestimated the sales, so they have overproduced their products. Now they have a large inventory. What happened? If there is a large inventory, if you look at the current ratio formula, it's current asset divided by current liability. So inventory is part of the current asset. So because they have a huge inventory, so the current asset will be big, and current asset divided by current liability will be maybe high, right? So you may interpret that this company is very liquid, but actually most of its assets, current assets, are inventory, and inventory, as I said, is the least liquid one, right? It's the least liquid, and it may be damaged, spoiled, or lost. So to have a better understanding of the liquidity of the firm, we can use quick ratio. For quick ratio, we exclude inventory from the formula, from the current ratio formula. So it's current asset minus inventory divided by current liability. It means we put aside inventory, and then whatever current asset we have, we divide it by current liability to see whether we are, to what extent we are able to cover our current liability using our current assets excluding inventory, because we know we can't convert inventory into cash quickly, right? So in this case, we have 0.53 times. 0.53 times. This means, you see, it's totally different. Actually, for the current ratio, you got 1.31 times. Now you got 0.53 times, right? It's totally different figure. So maybe now your interpretation has changed. Now you may ask, why do we need cash ratio? Because sometimes we want to know if quickly we want to cover the current liabilities, how successful we can do it. So we deduct everything from current assets and we only focus on cash. Cash is the most liquid one, right? So a very short-term creditor actually may be interested in these type of ratios, like cash ratios, right? So for cash ratio, we divide cash by current liability, and the amount of cash is reported here 98. So we divide 98 by 540 and we get 0.18 times. Means for $1 in current liability, we have 18 cents cash. So these three are the most common liquidity ratios that you may use.